Hey, we're here at a frozen Skakit beach here on Cape Cod with a quick follow-up to yesterday's video on Kevin Warsh and the Fed balance sheet. So again, the issue is whether some reduction in the Fed's balance sheet would allow for aggressive rate hikes by the Fed. My view is no. So there are two dimensions in which the balance sheet could affect financial conditions and the monetary stance. There's the asset side and the liability side. And this is from the Federal Reserve's perspective. So the asset side means the assets they're buying, the duration of those assets. They're taking bond duration out of the market. That suppresses yields a little bit, might push people into more risky assets and, ease financial conditions a little bit. My own view is it's not that big a deal. There are a lot of assets out there, and it's hard for them to, increase the overall supply of duration in treasuries and substitute fixed income assets. But that's not what we're going to discuss today, because the fact of the matter is they're not going to be doing that. There's no way Donald Trump is going to see his new Fed chair start hitting the market with, big sales of treasuries and pushing yields up. If there is any balance sheet reduction, it'll be coordinated with Treasury, who will accommodate the Fed's sales of duration by shortening the amount of duration that the Treasury issues to accommodate whatever the Fed might do. That's if they can work out how to do this. But the point being, we're not focused on the asset side of the Fed balance sheet, but the liability side mechanism, because that's really what Warsh focuses on as well, because he does talk about money supply being a driver of inflation. So when we talk about the liability side effect, that's the reserves that the central bank is creating to fund the purchase of their treasuries. And what effect does that have on the behavior of banks and on the supply of money in the system and therefore monetary conditions? And again, my story here is not that much. So here's an analogy that sort of explains how I think about this. So imagine a fire you're building with a bunch of logs on a grate, and under that fire is a gas burner with a modulation knob, and that would be the Fed funds rate, and the pile of logs would be the money supply. So let's say you've got 23 logs on there, one for each of the $1 trillion in outstanding money supply. Let's say Warsh could pull off a $3 trillion reduction in the Fed balance sheet, and that produces a $3 trillion reduction in M2. It might or might not, by the way. The Fed's QE in 2008 to 2013 didn't affect M2 much at all. So it's unclear that even sucking $3 trillion of reserves out would reduce M2 by $3 trillion, but let's say it does. So the Fed's building this fire, and the heat that it produces is the monetary stance they want to achieve. So they want to modulate the heat of this fire using the gas and the logs to produce, let's call it nominal GDP at a run rate of potential growth plus 2%. That'll give them a 2% inflation rate. Let's say they've got this fire burning, just perfectly. And frankly, over the last 3 years, nominal GDP has been rock steady, the lowest volatility we've seen in really generations. So very good job by the Fed of modulating that fire and keeping it steady. Warsh wants to pull 3 logs off the fire out of the 23 by reducing the money supply. Will that bring the heat down? A little bit. So how much will the Fed have to turn the burner up, i.e. reduce the funds rate, to increase the heat back to where they want it? My contention is not very much. But that's just, my intuition based on, again, this framing of how I think about this and my observing this process over the last 2 decades plus. I just don't think it would take much in the way of funds rate reductions to offset a shrinkage of 2 or 3 trillion in the money supply. Now, don't at me if you disagree. I'm not sure that this is a debate that's provable on one side or the other. But my hope is that this framework will help to illustrate how I'm thinking about this and why I think just removing a few logs, you're not going to have to turn that heat up very much to get back to the amount of monetary stimulus the Fed wants to be injecting into the economy at any point in time. Thanks.